There's a famous bet Warren Buffett made in 2007. He wagered $1 million that a simple S&P 500 index fund would beat any collection of hedge funds over 10 years. He won. And it wasn't even close. The index fund returned 125%. The hedge funds returned 36%. So does that mean you should only buy index funds? Not necessarily. Let me explain when each approach actually makes sense. The case for index funds is simple and powerful. The S&P 500 has returned about 10 to 12% annually over the last century, including dividends. That's with zero effort, no research, no stock picking, no watching earnings calls. You just buy and hold. Warren Buffett himself has said that most investors would be better off in a low-cost index fund. And the data backs him up. Over any 20-year period in history, the S&P 500 has never lost money. Not during the dot-com crash, not during 2008, not during COVID. Time in the market beats timing the market every single time. But here's the other side. Individual stock picking, done well, can significantly outperform the index. If you bought Apple in 2010, you'd be up over 1,000%. Microsoft, Amazon, Nvidia all crushed the S&P over the last decade, and it's not just tech. Disciplined value investors like Warren Buffett have beaten the market for decades by finding undervalued companies and holding them. The key phrase there is done well, because most stock pickers don't beat the index. Studies show that over 90% of actively managed funds underperform the S&P 500 over a 15-year period. Individual investors do even worse on average because of emotional trading, buying high and selling low. Let's compare them head-to-head. Returns. Index funds give you the market average, roughly 10% a year. Individual stocks give you the potential for more, but also the potential for much less, or even total loss. Risk. An index fund holds 500 companies. If one goes bankrupt, you barely notice. If you own 5 stocks and one goes bankrupt, that's 20% of your portfolio gone. Time commitment. Index funds take minutes per year. Serious stock picking takes hours per week, reading financial statements, tracking earnings, monitoring positions. Tax efficiency. Index funds are extremely tax efficient. Frequent stock trading generates short-term capital gains taxed at your income rate, up to 37%. And fees. Index funds charge 0.003 to 0.10% annually. Active stock trading costs you in commissions, spreads, and tax drag. Here's what smart investors actually do. They use both. A common approach is the core satellite model. Your core, 60 to 80% of your portfolio, goes into low-cost index funds. Set it, forget it. Let compounding do its thing. Your satellite, the remaining 20 to 40%, goes into individual stocks or strategies you have conviction in. Maybe you run the options wheel on dividend stocks. Maybe you invest in companies you understand deeply. This way, your wealth grows no matter what, and you have a sandbox to try to beat the market without risking your entire future on stock picks. So which is better? For most people, index funds win on simplicity, consistency, and tax efficiency. But if you're willing to put in the work, a hybrid approach lets you capture the best of both worlds. The worst thing you can do is nothing. Whether it's index funds, individual stocks, or both, start investing today. If you want to learn more about using individual stocks for income through the options wheel strategy, check the link in the description. Subscribe for more data-driven investing content every week.